So, if you're in crypto, you know the tax rules have always felt, well, a little like the Wild West, right? A bit of a gray area. Well, get ready because those days are officially over. We're about to break down some critical new tax reporting rules based on insights from expert Clinton Donnelly that are going to change everything. Let's dig into what's happening and what it means for you. Let's just start with this one number because it really sets the stage. Experts estimate that a jaw-dropping 75% of U.S. crypto traders are not fully reporting their income. That is a huge compliance gap, and you better believe the IRS is gearing up to close it.
And this quote from Clinton Donnelly, man, it just hits the nail on the head. For years, the IRS was kind of playing catch-up, right? Trying to piece together what was actually happening with crypto transactions. Well, that whole era is finished. The agency has a brand new set of eyes, and this change is happening way faster than most people realize.
So, what are these new eyes I'm talking about? Well, it all starts with one simple piece of paper. But trust me, this thing is a total game changer for every single crypto trader in the US. Everybody meet Form 1099-DA. The easiest way to think about it is like the 1099 you get from your stockbroker, but for your crypto. For the very first time, US exchanges are going to be legally required to send this form detailing your activity straight to the IRS. No more guesswork, no more ambiguity. And look, this isn't some surprise attack from regulators. This has been in the works since 2021. We are now in the final countdown to January 1st, 2026. That's the day this becomes mandatory. The window to get ready is closing, and it's closing fast.
And when I say the reporting on your activity, I mean everything. It's not just when you cash out to dollars. We're talking every single sale, every swap you make between tokens, every exchange, and, crucially, every single transfer in or out of your account. Nothing gets missed. Period.
Okay, I can hear you thinking it now. Fine, I'll just move my trading to a foreign exchange to stay off the IRS's radar. And yeah, for years, that was a pretty common strategy. But a new global framework is about to slam that loophole shut for good. Yeah, that old trick of using foreign exchanges to keep things private, it's officially obsolete. The new reality is that those exact same foreign exchanges are about to start automatically reporting all of your activity directly back to the IRS. There's really nowhere left to run. So what's making this all possible? It's something called CARF, the Crypto Asset Reporting Framework. Just think of it like a global information sharing superhighway for tax agencies. Starting in 2027, countries all over the world will automatically scoop up crypto user data and share it with each other. And here's how it's going to work. In 4 simple steps. A foreign exchange gets your full Know Your Customer info. They see your tax residency is the US, they grab your tax ID number, and then, poof, they package up all your transaction data and send it right back home to the IRS. It's a completely sealed loop. And this next part, this is absolutely critical. Unlike a lot of traditional financial reporting, SARF has zero, and I mean zero, minimum thresholds. We're not just talking about big trades. This means every little sale, every swap, even tiny transfers you make between your own wallets, it is all going on the report. So, we've covered US exchanges, we've covered foreign exchanges, but what about the big one, the final frontier of crypto privacy, your own private self-custody wallets? Well, the new rules have an answer for that too. And folks, it really does signal the end of anonymity as we knew it. This is the question on everybody's mind, isn't it? Surely the wallets I control, where I hold my own keys, they're safe, right? The thinking has always been that what happens in your private wallet stays in your private wallet. Well, that's just not a safe assumption anymore. And here's why. Remember how Form 1099-DA and CARF report every single transfer? Well, every time you move crypto from your verified exchange account to your private wallet, that transaction creates a digital breadcrumb, a direct link. The report shows the exchange, it shows your identity, and it shows the receiving wallet address. Do that enough times, and regulators can basically build a map of your entire crypto world. And if you think this is all just some far-off theory, let's talk about the very real 2024 tax evasion case against Roger Ver, one of the earliest and most famous Bitcoin evangelists. How did prosecutors build their case? They did exactly what we just described. They used blockchain forensics to trace his wallets, link them all together, and reconstruct a whole decade of transactions. This isn't a future threat, it is happening right now. So all of this, it leads to a pretty serious conclusion. With this new era of total visibility right around the corner, the consequences for not being compliant are becoming incredibly severe. Let's talk about the penalties and the final warning from the experts. And get this, the IRS is actually changing its whole playbook. They're moving away from complicated civil audits and are leaning much more into criminal charges. And why? Well, honestly, because the bar for a criminal indictment is lower. They don't have to perfectly reconstruct every trade you ever made. They just need to prove you had income, you knew about it, and you didn't report it. So what does a criminal charge actually look like? Well, it could mean prison time. We're talking up to 5 years per count. That means for every single false tax return you've ever filed. The risk is no longer just about money. It's life-changing.
And then, on top of potential prison time, you've got the fines. Again, per count, these penalties can go as high as $250,000. When you start adding up the potential jail time and the fines, the stakes for getting this wrong become, well, astronomical.
So we'll end with this final, incredibly powerful warning from Clinton Donnelly. It just perfectly wraps up everything we've talked about. This new era of total visibility is coming. The systems are being put in place as we speak, and what that means is you have a very limited and shrinking window of opportunity to go back and get your past in order. And that leaves all of us with one final, very personal question. With the IRS and regulators all over the world about to see everything, from your U.S. exchange trades to your foreign transfers and even into your self-custody wallets, is your past fixed?